What does Uber, Spotify, and The Iconic all have in common? Startups that dominate their respective industries, right? But don't you think it's crazy how these giants continue to grow their empires without turning over a profit? I mean, how's that even possible? Let your favorite accountant break it down for you. We all know how Uber works. It's the middleman between drivers and passengers, allowing you to find a ride or a feed with just a few taps on the phone. Innovative, right? A convenient way to avoid the trouble of calling a cab. Today, Uber has 130 million monthly users, operates across 70 plus countries, and does $32 billion in net revenue. Sounds pretty darn good, but despite this success, it took Uber 14 years to finally deliver its first quarterly profit result in 2023. How is that even possible to operate a business of that scale without even making money? Uber's goal was simple: try to monopolize the transportation services industry. To do that, Uber employed the same strategy held by many tech startups: sacrifice profits today in hopes of maximizing profits in the future. Uber focused on aggressively growing its user base, expanding into new markets, and investing in innovative technologies and services, all with market domination in mind. In order to achieve this, huge investments in research, technology, marketing, and operations were required. To disrupt the market and compete with existing transportation and delivery operations, you would have to pour in a lot of money now and reap the rewards only once these investments create operational efficiencies, achieve economies of scale, bring down labor costs, and optimize tech. And as Uber has proven, this still doesn't guarantee financial success. It's been a long 14-year ride with plenty of speed bumps along the way, and even though they just had their first profitable quarter, Uber still isn't quite in the clear just yet. Here are 3 ways how Uber built a money-burning engine. Pricing model. In order to still share away from the taxis and cabs, Uber normally operates as a loss leader, discounting the cost of rides to attract more passengers to its platform. By subsidizing the costs, Uber hopes to attract passengers enticed by lower fares and attract drivers seeking the demand for rides. This is a really great strategy to create a loyal base of passengers and drivers, but it gets a lot trickier when trying to make money. When Uber is ready to capitalize on its loyal users by increasing prices to better its margins, it will struggle as passengers and drivers have opposing interests. Drivers want to make as much money as they can, so higher fares naturally draws in more Uber drivers, but at the same time, you'll push away Uber passengers who are turned off by the increasing costs. On the flip side, passengers want to pay as little as possible, so lower prices will generate more passenger demand, but at the same time push away Uber drivers who wouldn't make as much money as they could elsewhere. The other added layer of complexity in this equation is the emergence of competitors like Lyft, which also undercut their prices, making it harder for Uber to improve profits by leveraging price, since they're not only competing with taxis now, but also other rideshare services. Diversification. With domination in mind, Uber has also invested in diversifying its portfolio of services from self-driving cars to freight transportations. While some ventures like Uber Eats and Postmates have proven successful, other adjacent businesses like Uber Rush, a package delivery service, or auto leasing programs were a bust. These are not cheap decisions to start and shelf and eat into Uber's cash flow. Legal battles. On top of all of this, Uber has faced regulatory and legal challenges in many of the regions it's expanded to, from how they view and treat their drivers, reckless and negligent behavior when launching in new markets, and disregard for the intricacies of existing taxi industries. Honestly, this is a can of worms in itself. If you have the time or need a late night rabbit hole to burrow through, look into Uber's shady dealings in countries like France. It's pretty horrific. Having to fight regulators for the right to operate your business with an unconventional and not always well-received business model will never be cheap. There's also the damage it does to brand image and the public perception if you don't navigate it the right way. So you can see how the things that make Uber so unique are also the things that anchor it down. But how is it able to keep operating when it's not even making money? The answer really comes down to investors. Just like the other big tech companies, investors apply a growth value logic. Here, investors believe that as long as Uber continues to grow its user base and dominance in the industry, the business will eventually find a way to monetize and reach profitability. In other words, as Uber grows, the stock prices rises, and the company uses its growing valuation to raise more money. Investors focus on making money using Uber's share price as opposed to returns from profits. Another example is Spotify. Spotify revolutionized the way we consume music, allowing users to subscribe to a music library that can stream wherever they are, rather than having to buy songs or albums individually. With more than 500 million active monthly listeners, Spotify, like Uber, has never ever reported an annual profit. The reason? Another broken business model. Spotify generates revenue by monetizing its user base. 40% pay a monthly subscription for access to premium features, whilst the other 60% use the free, ad-supported version. But here's the catch. Spotify loses more than 2/3 of every dollar it makes from subscriptions and advertising to paid record labels, artists, and studios. That leaves Spotify with around 30% of all the money it makes to pay staff, cover marketing budgets, invest in technology, cover artist engagement and label management, manage legal costs, and everything else in between. Unlike Netflix, which pays a lump sum for the rights for people to stream content on their app, Spotify pays labels and artists per stream. Since subscription fees are a flat rate, fixed month to month, the more people that use the service, the more Spotify misses out. Recognizing how unsustainable this model was, Spotify revised its strategy to focus on improving profit margins. Instead of concentrating predominantly on music, Spotify expanded its scope. Understanding the value of commercializing podcasts, Spotify saw itself not just a music streaming service, but a total audio one. Striking exclusive deals with the likes of Joe Rogan, the Obamas, and Kim Kardashian, the idea was that owning the content and not having to pay licensing costs makes monetizing podcasts through sponsorships and brand deals much more profitable. The strategy makes sense, but it hasn't quite made the impact on the numbers that Spotify was hoping for. Spotify's recent venture into audiobooks is another attempt to increase margins. So how does Spotify continue to function at a loss? It's the same story as Uber. Investors. Investors don't always care about long-term potential or the ability to execute on a vision or profitability. Sometimes all they care about is the share price. As Spotify grows, so does the share price, keeping shareholders happy and in turn allows Spotify to finance operational activity. This setup has worked well in the past, but Spotify, reporting slower growth than expected, saw the stock price nosedive too. So how long is this model really sustainable for? Sometimes it's hard to believe that companies at the scale of Uber and Spotify can't figure out ways to make profit. With broken business models and no light at the end of the tunnel, it's investors' optimism about the share price and belief in the commercialization of user bases that keeps them afloat. Join us next time where your friendly neighborhood taxman will explain if AI will steal your job.